Saurabh, good morning. Thank you for joining us. We are programmed to feel happy or unhappy when market goes up or low. But right now it's about Olympics. They say life
Right, I
is a
think,
mean reversion, but when it comes to Olympics, nothing changes.
yeah, I think there's a certain pattern to life which is returning. It's good to see that. I think it's good to watch Olympics and believe that the world is gradually returning to normal, and hopefully the markets will reflect the normality over the coming year, Nikunj.
Were you a bit surprised in a negative manner when you heard HDFC Bank and Bajaj Finance acknowledging that the quarter gone by was a painful one and they've seen an uptick in the retail delinquency?
No, I think we would be alarmed if they hadn't announced the jump in provisions. I think all of us knew that the May second wave was abrupt. It was sudden, and it was a pretty powerful wave, right? I think all of us felt the impact on our personal lives, and clearly the country suffered badly through May. So at one level, it's actually reassuring to see the leading lenders in the country acknowledge that in their results. And all of that being said, whether it's HDFC and Bajaj, which are in our portfolio, or say a bank like Axis Bank, which is in our Kings of Capital portfolio, it's reassuring to see these lenders use their COVID provisions. All three lenders that I just mentioned had created massive COVID buffers last year, and they've made good use of that in the 1Q results. So have the life insurers and general insurers. So ICICI Lombard is in our portfolio as well, and they've made use of their provisioning to deal with the increase in health claims from COVID. So it's reassuring to see that. I'm not going to lose too much sleep about the 1Q COVID hits that the best insurers and lenders in our country have suffered, because I do believe it's a one-off. Overall, the picture that we got from the 1Q results is that the country as a whole has recovered nicely through June, July. And as I was saying, as normality returns to the world, we should see sparkling results from the best lenders, insurers, and asset managers in India for the rest of the fiscal.
Okay. Saurabh, the other surprise which frankly has come is the way how consumer staples have reported volume growth. Whether it is HUL or what we've heard from ITC's FMCG business. I'm keeping cigarette business aside for a minute. Must say that the second wave, while it may have impacted retail delinquency for lenders, at least for staples, there is a bit of a relief.
I think generally, Nikunj, what's happening is as we come out of COVID, slowly but surely, there is pent up demand across all spectrums of spending. So whether it is at the consumer durables or auto segment, where companies like Havells in consumer durables, or indeed a Maruti Suzuki in the auto segment, which I think will continue to benefit as we come out of COVID, or indeed at the staples end, the companies you just mentioned, you're seeing a nice pickup in volume growth across the piece. And to be fair, this is a global phenomenon. Across the world, we are seeing demand bounce back for everything from cars to holidays to financial services products. And I would attribute that to basically 4 to 5 quarters of people suppressing spending as COVID pulverized their lives, their jobs, their businesses. As you turn the tap back towards normality, I think we will see 2 to 3 quarters of solid growth in top lines. I think the big concern for all of us should be in the coming quarters, not top line growth. I think top line growth will not be a concern over the next 2 to 3 quarters. The next 2 to 3 quarters will really be about dealing with inflationary pressures. And I think the best companies will pull away from the rest by the way they protect their operating margins from what are clearly very powerful inflationary pressures, whether it's labor costs, raw material costs, shipping costs, semiconductor costs. Across the world, you've got very strong raw material cost pressures coming through. And I think that's where the men and the boys will separate from each other over the remaining fiscal as to who can protect EBITDA margins in an environment where growth itself in top line will be quite abundant.
Hi, Saurabh. Good morning. And yes, well, I think the competition of sorts will shift from the top line to the margins and the bottom line. And Saurabh, which sectors do you think are going to be most vulnerable to this tremendous cost inflation that we've been seeing so far this year?
I think if I had to choose choose two sectors which I think will do well in this scenario, and a couple of sectors which could suffer in this construct. I think sectors where the underlying demand is relatively inelastic, right? So FMCG, Nikunj mentioned, I would put in that category. Some of my favorite stocks, such as Asian Paints and Pidilite, I would put in that category. Demand is relatively inelastic. And if you're a market-leading franchise, you've got the pricing power, you've got the distribution network, you should be able to protect your margins for the remainder of the fiscal. And we've done a fair bit of data crunching on this. If we look back at the last 20 years, whenever CPI inflation crosses 6%, you do see the quality premium open up that much more, because quality franchises are able to protect their operating margins from inflationary pressures. I would say top quality FMCG plays will do very well in this sort of climate. Similarly, strong lenders. We are in a country where loan book demand should come back relatively strongly for the remainder of the fiscal. If you're a high quality lender, you're able to keep your funding costs and your provisioning under control for the rest of the fiscal, you should be able to publish sparkling results in the post-COVID world. Where I think the concerns will be greater will be, say, auto ancillaries or second-rung auto OEMs and, say, the auto ancillary pack. I think there's likely to be heavy-duty operating margin pressure there. Similarly, second-rung IT services stocks. Staff costs are roaring through. It's a very difficult environment for second-rung IT companies because holding on to talent has become very difficult. It's a heated market for talent. So I'd be careful in the IT sector. I think beyond TCS and Infosys, I would expect to see fairly powerful operating margin pressures in the rest of the sector. I'd be careful in auto and auto ancillaries, where although top line will come through nicely, I think operating margin concerns will become elevated as the year progresses. This looks like a classic boom scenario, where growth comes through, but so does inflation, and the women and the girls get separated, the men and the boys get separated, so to speak.
All right. Well, it's interesting you mentioned, those some of those mid-cap IT names, and yeah, well, you rightly said that, because a lot of the companies have warned of their attrition figure as well. Labor costs too, along with the other costs, has been increasing, and IT would. Will have to deal with that factor. Moreover, the mid-cap and the small-cap IT names. What about metals then, Saurabh? Because that's something that directly deals with the vagaries of the commodity up cycles and down cycles. At a time like this, when metal stocks have already run up quite a bit, what would be your positioning in them?
Because I've said on your shows before, we've never invested in Marcellus, we've never invested in metal stocks, because we could never quite understood how we in Marcellus can call the global commodity cycle. That being said, it is relatively clear that for the next couple of years, there's very little incremental supply coming. So whether it's steel or aluminum, the new capex cycle is just about beginning across the world. By the time the new capacity addition cycle brings fresh supply on stream, it'll be 3 years out at least. And therefore, you've got a 2 to 3 year window where demand zips up, but supply lags. And therefore, you should have a fairly healthy environment for these stocks. We are not going to invest in the sector for a variety of reasons, particularly our inability to second guess what happens to the demand on the metals piece. 70 to 80% of the stock price movement in this sector basically reflects the underlying commodity price movements on the London Metal Exchange. And therefore, if anybody watching this program is investing in metal stocks, you should be a fairly good judge of where the overall metal cycle is going. And if you believe that the overall metal cycle still has got legs in it in terms of the overall commodity prices running up for a couple of years, these are perfectly good investments for you to consider. For our part, we'll stick to top quality franchises with great pricing power, because we believe that's a much better risk-adjusted way of playing this incipient economic boom across the world.
Right. Saurabh, you were one of the first to get a little wary about Reliance Industries and the prospects going forward. And we've seen almost a 6-month kind of patch of underperformance or consolidation for the stock. when it came to the earnings as well, much unlike the AGM, you didn't see any incremental update on new energy, Geophone Plus, the O2C stake sale, or the recent Just Dial acquisition as well. Do you think this patch of underperformance is here to stay for some more time?
Look, honestly, because we haven't invested in the stock, I'm not an expert on it. What we've been very vocal about is this is one of the great corporate repositionings, I think, done anywhere in the world. To take a fairly, old-style conglomerate which was focused on petrochemicals, re-engineer it and turn it into a modern conglomerate focused on telecom, on retail. I think takes a lot of skill, takes a lot of hard work. They seem to be making good progress there. As I've said before, the area where we've remained circumspect about this company is on free cash flow generation. There's a lot of heavy duty spend involved in building out a telecom network and building out a successful retailing franchise. It's not clear looking across the world, not just India. Across the world, it's not clear that telecom produces free cash flows, right? So whether it's in the Western world or indeed in India, it's not clear over the last 20 years that telecom generates a lot of free cash flow, and hence the circumspection. But other than that, the repositioning from petrochemicals and oil and gas towards telecom and retail has been stellar, and let's hope that the company continues to progress nicely, and perhaps one day the free cash flows will come through, and we'll consider looking at the stock more carefully then.
Got to ask you, Saurabh, what is it that you're making of Zomato? Were you a subscriber in the IPO? Are you a shareholder yet? Because very varied and contrasting views. I was just reading a note by UBS. They've put a price tag at 165 already on Zomato. And on the other hand, you have an Aswad Damodran saying that the fair value should be 40 rupees per share.
So look, I think these sorts of polar, sort of opposite views are to be expected in a sector which is still in its infancy. Obviously, forget free cash flow, even profitability is some way away from many of the new generation tech plays. What we've done is we've chosen to invest in InfoEdge. So for a long time now, I think for a good 3 years now, in several of our portfolios, we have InfoEdge. And the reason we've chosen to benefit from this, the digitization of our country through InfoEdge rather than going forth and looking at, say, stocks like Zomato is, InfoEdge has at its core a very powerful cash generation machine called Naukri.com. If you're a HR officer anywhere in the country watching this program, I'm sure you'll agree with me that it's difficult for HR officers to operate without Naukri.com as a core subscription in their lives. That gives InfoEdge a massive cash generation engine. And what our math suggests is that the Sanjeev Bikhchandani, Hitesh Oberoi team over the last 20 years have taken the free cash flows from Naukri, reinvested them spectacularly in Policy Bazaar, Zomato, the matrimony space. Our reckoning is that the XIRR, the return on the reinvested cash, is somewhere around 30 to 40% for InfoEdge, and hence we've been long-standing fans of InfoEdge, and we'll carry on holding that stock as our way to benefit from the digitization of the country. What is Zomato's fair value? I honestly don't know. We haven't invested in the IPO, but this whole digitization of the country will progress, and it will lead to say 15 to 20 giant companies dominating our economy. Already 20 giant companies account for 90% of corporate India's profits. And basically, if you and I are investing in India, these 20 companies should be the fulcrum of an Indian portfolio. They are basically running our economy, and this pattern of few large companies becoming stronger will continue as we integrate the economy, as digitization creates. Digitization helps the strong get stronger in the post-COVID world.
Saurabh, there were a lot of naysayers when Facebook went public. Based on the old school thoughts of cash flow and dividend yield, a lot of marquee investors called social media stocks more like a bubble. Today they have a market cap, and today they have a relevance, and today they have an importance in our daily life. What happens to the other internet companies when they will go public? Because it starts with Zomato, then you got Policy Bazaar, then you got Nykaa, then you got delivery. Some are real businesses, Saurabh, and some of these businesses will exist till the time our, till the time our children's they, start and go to they come out of school. What I'm trying to understand is that how does one go about investing in this so-called platform stroke digital economy?
Well, I think it's a super question, and honestly, you're right. This is a question which has befuddled many. I think there are two dimensions to the debate which are still a little murky. The first is how will governments across the world deal with the power of these digital platforms? Right? We can see in China a bit of a showdown between some of the biggest names in the Chinese economy, biggest digital names in the Chinese economy and the Chinese government. And the showdown seems to be, Nikunj, as much about data. Who owns the data? Right? You're a giant Chinese company. You've got data on billions of Chinese consumers. Does the Chinese government have access? Should the Chinese government have access to the data, or does that belong to the private sector? And linked to that is, if you're a monopoly provider of catering services or online financial services or social media services, should the government be regulating you both from an ethical perspective and from a profitability perspective? I think this is a massive debate. It's taking place in China. It's taking place in America. I think Lina Khan's appointment by Joe Biden will have enormous ramifications on this debate. So there's a big regulatory debate that's taking place, and I think that will create volatility in stock prices of these companies across the world. And I doubt India will escape that debate, right? If a government makes a call on who owns the data and what sort of profitability you're allowed to generate, it obviously will have massive ramifications on share prices. The second aspect of uncertainty is how easy is it to disrupt these network businesses? Facebook is unusual. Facebook is a network business where each Facebook customer benefits from other people joining Facebook. So the network effects are actually very pronounced there. But it isn't as pronounced in, say, an Uber, or in the Indian context, an Ola. It isn't as, the network effects aren't as pronounced in a restaurant delivery business, because each restaurant doesn't benefit from another restaurant joining the Zomato network. So the network effects are actually subtly different, and the differences in network effects make some of these businesses easier to disrupt than, say, it is to disrupt a social media business like Facebook. There are differences in the strength of the business models, and I don't think that those differences in the strength of the business models is as yet reflected in share prices across the world. My reckoning is the next 3, 4, 5 years, the market will wake up to the fact that the defensibility, the ability to protect the franchise is fundamentally different for some network businesses than it is for others. So two different discourses, a massive regulatory debate about these platforms, and secondly, the ability of these platforms to be disrupted by a new generation of entrants. And I think that these two debates will define where the share prices of these stocks go over the coming 4 or 5 years.
So wonderfully well that we'll revisit this view of yours in coming shows. Now I'm going to take a leaf from your earlier answer, which is that IT business or the IT service sector is in a sweet spot. You can see all the so-called telltale signs. High attrition means demand for IT professionals and talent. Double-digit growth means that business is becoming big. Fat deal pipe means that margins are coming back. How does one go about investing in some of the large cap stocks? Because TCS or Infosys now, they're trading at the upper end of the P multiple. Where do you think these stocks are headed after the recent run-up?
So we've spoken to a lot of CTOs of Western companies over the last year or so. And the picture they are giving us is that over the next 4 or 5 years, say the top 1,000 Western companies have, each of them have basically 4 or 5 years of heavy duty work as they try to digitize their own businesses. They want to take their old economy IT constructs where they had servers and server farms and so on, and move to a new economy construct where the data is on the cloud, where they have data lakes and they have modern analytics, and the whole business model gets reinvented around AI, around using real-time analytics to recreate supply chains which are more responsive to customer demand, to economic patterns, right? Each of the Western companies needs to do it. If they don't do it, they will get blown out of the water. And therefore, for the Indian IT services giants, say an investee companies of ours like TCS, and say for other leading firms like Infosys, there's potentially 4 or 5 years of solid revenue visibility, solid business pipeline visibility across the top 1,000 Western clients. The challenges are threefold. Firstly, given the sheer scale of the work, the Western CTO or the Western Chief Operating Officer is saying, I don't want to deal with an army of IT services companies. I want 1 or 2 lead vendors, say perhaps a Western company like Accenture and 1 top Indian company. And these guys, these two of my trusted IT services vendors will run the rest of the process. So you as an Indian IT services company do have to be able to go to the table with a wide suite of offerings. That means you have to have talent, which is broad-based. You have to have a wide offering suite, and you need to be able to fill your staffing pipeline at great speed, something which a TCS and an Infosys are very good at, but I'm not so sure how good the mid-cap IT companies are. In fact, you've seen in recent results, even some of the larger IT companies saying they're turning away business because they simply can't find people. So I think the first criteria will be, can you staff up at great speed to deal with the sheer extent of demand? The second area is, can you keep up with the changes in technology? So AI itself is moving very fast. To keep up with it requires billions of dollars of spend on the part of a large IT company. Even in Accenture, if you look at Accenture's annual report, they're spending billions of dollars to stay ahead of the curve. I'm not so sure the Indian mid-cap IT companies have that sort of financial firepower to stay ahead of the AI curve. And the last piece is strategy. Tech and strategy, IT services and business strategy are basically one and the same. How many of our IT services companies can claim that they can sit with a CEO of a Fortune 500 company and guide corporate strategy? I think the answer there is there's probably 2 or 3 such companies in our country. The rest of the companies will have to be content in being backroom boys. So the good news for Indian IT, massive boom in demand, lots of work, and this is C-suite work. This is not back office work. The bad news, can you get the talent? Do you have the C-suite connectivity? And can you spend the requisite amount of money to stay ahead of the curve on technology? So this is probably the best demand environment for Indian IT in 20, 25 years. This will last for some time. We are focusing on TCS as our main play here, but it could well be that TCS and a couple of other companies make hay over the next 4 or 5 years. I wouldn't be a seller of IT stocks at this juncture, but I would be careful about the other aspects, the cost pressure aspect and the strategic aspect of IT, which is changing the world that we live in.
Okay, Saurabh, great to have you on the show. We let you go on that note. Good chat.